In today's video, we're breaking down how the tension between the world's two biggest economies could affect your retirement savings, even if you've never invested directly in the US or China. Hi, I'm Matt, and I make complex topics simple. If you want more videos like this that help you protect and grow your money, make sure you hit that subscribe button and tap the bell so you never miss an update. Let's dive in. The basics of the US-China trade war. The US-China trade war kicked off in 2018 when the US started placing tariffs on Chinese imports, accusing China of unfair trade practices. China responded with its own tariffs. Since then, it's been a back and forth of new taxes, restrictions, and political tension. What's important to know is that when two major economies go head-to-head like this, it sends shockwaves through global trade. Businesses, investors, and governments all start to adjust, sometimes quickly and sometimes painfully. And that's where your retirement savings come in. Stock market volatility. When the US or China announce new tariffs or restrictions, the stock market usually reacts, and not always in a good way. Markets hate uncertainty, and the trade war creates a lot of it. If you've got superannuation or retirement investments tied to shares, especially international shares, then your portfolio could dip when global markets wobble. Even if you're mostly in Aussie stocks, big companies here can still get hit. Why? Because many of them rely on exports, and when global trade slows, so do their profits. You don't have to be directly invested in the US or China to feel the ripple effect. Slower global growth. A trade war doesn't just hit the US and China. It drags down the whole global economy. When tariffs go up, companies hesitate to invest. Supply chains get disrupted. Consumer prices rise. And that all leads to slower growth. When economic growth slows, company earnings tend to shrink. And when earnings shrink, stock prices fall. It's a chain reaction that can weaken the long-term returns of your retirement investments. If your fund manager isn't adjusting for this kind of risk, or if your portfolio is too exposed to sectors under pressure, your nest egg could grow slower than expected, or even lose value in the short term. Currency fluctuations. Trade wars also cause currencies to swing. When tensions rise, the Aussie dollar often drops against the US dollar. If that happens, your international investments might look better in Aussie dollars, which is good. But the downside? Imported goods become more expensive, travel costs more, and inflation can start creeping in. That matters because inflation eats away at the purchasing power of your retirement savings. You might end up needing more just to maintain the same standard of living. Interest rates and bonds. Trade wars can also affect interest rates. Central banks, like the Reserve Bank of Australia or the US Federal Reserve, often lower rates when global growth is threatened. Lower interest rates can be a double-edged sword. On one hand, they support stock prices. On the other, they reduce returns from bonds and savings accounts. If your retirement portfolio includes fixed income assets, your returns might be lower for longer. It also means if you're nearing retirement and hoping to live off interest or dividend income, you'll need to plan more carefully. Winners and losers. Here's where it gets interesting. Every crisis creates opportunity. Some sectors or countries benefit from the US-China tensions. For example, countries like Vietnam, Mexico, and India have gained manufacturing business that used to go to China. Tech companies that help diversify supply chains have seen growth, and even some Aussie firms are stepping in to fill trade gaps. If your retirement fund is actively managed, the fund manager might shift to take advantage of these changes. But if you're in a passive or outdated fund that doesn't adapt, you could miss out on the upside and carry the downside risk. What you can do. So how do you protect your retirement savings during a trade war? Diversify your investments. Don't rely too heavily on any one country, sector, or currency. Review your super or retirement fund. Make sure it's not stuck in underperforming sectors or old world strategies. Keep an eye on fees. When returns are under pressure, high fees hurt more. Stay calm. Trade tensions come and go. A long-term plan that's reviewed regularly usually beats jumping in and out based on fear. Talk to a pro. If you're unsure, a financial advisor can help you position your portfolio for resilience. The US-China trade war might feel like it's happening far away, but its effects are much closer to home than most people think. Whether it's market volatility, inflation, or shifting global trends, it all matters for your future. So don't ignore the headlines. Stay informed, ask questions, and make sure your retirement savings are built for both the calm and the storm. If you found this video helpful, give it a like and leave a comment below. How are you feeling about your retirement strategy in times like these? And don't forget to subscribe for more easy-to-understand finance videos. Thanks for watching, and I'll see you in the next one.